Welcome back to the Value Investors Club. I'm your host, Simon Wunderlich. Let's get right into it with VIC Readings, the format where we look at the best of the best investment recommendations by the best of the best value investors out there. Today, we have Ranger Energy Services, ticker is RNGR, filed on November 2nd by Goop, 392. Price at that point was $10. This is not a recommendation, not advice. Please do your own due diligence before investing into anything. This is only entertainment description. Come on. Admit it. You just want one more chance to lose dollars in the Marcellus. Ranger Energy Services, RNGR, $10, $250 million market cap, 45 million net debt, valuation 3.75x 2022 E, sub 3x 2023 E. Well-positioned oil field services company benefiting from the Patriot and PerfX wireline acquisitions in early 2021 and hugely accretive acquisition of basics, rigs, and other services lines and assets out of bankruptcy in August 2021. True earnings power of the core and acquired assets just emerging now into sector upcycle. Current asset base has revenue potential of 765 million at 20% margins, implying 150 million EBITDA versus 2022 estimates of 650 million to 80 million and second half year 2022 revenues of 330 million to 340 from 330 to 340. Current 2023 EBITDA is in the 100 to 110 million dollar range. Rigs in reserve will only be utilized at higher RICs. Stellar pickoff of the basic assets in BK auction and definite turn in cycle has positioned the company for meaningful margin expansion and FCF ramp. Bought a basic for net cost of 42 million, currently running at EBITDA of 12 million per quarter. Acquired significant excess assets in the basic purchase. Many older rigs were scrapped, and other excess real estate and assets are being sold and rapidly reducing debt. Bought Patriot for 12 million, currently running at 2 to 3 million EBITDA per quarter. Net debt already well under 1x EBITDA run rate. Management targets zero net debt before considering further consolidation. Board also discussing shareholder returns given overall valuation less than 3x run rate EBITDA. FCF should accelerate as CapEx is disciplined, 15 to 20 million, and rapid debt paydown works down interest expense. 2023 FCF should approach 50 million or $2 per share, a 20% yield on an essentially debt-free balance sheet. NOLs will cover cash taxes at least into 2024. LT maintenance capex should run 4 to 6% of revenue, including costs to reactivate availability capacity. Can't bring myself to actually type that an energy company management is too conservative, but Stuart Bodden, CEO, and Melissa Kugel, CFO, are taking it slow with the balance sheet while making great strides with all of the acquired operations. They understand the acquisition versus buyback math, but think they can do further consolidation at very attractive returns. In aggregate, the 2021 acquisition provided a valuable scale and operating leverage to an expected multi-year upcycle. 1x turn on 2023, feed $4 or 40% upside. Holding the 2022 EBITDA multiple on the higher 2023 EBITDA gets you to the same level. On the Q3 call, management guiding to revenues 615 million to 20 million and EBITDA margins at the high end of the original 11 to 13% range. Implies 75 to 80 million EBITDA. Net debt down to 45 million. Strong desire to get to zero net debt given prior experiences. Probably overly conservative, but certainly de-risking. FCF, $8 million could have been higher, but some WC built given strong business results. Still expect a capex of 50 million versus DNA of 40 million. Very disciplined. Processing solutions and wireline both very strong. High spec rigs up another 3% quarter to quarter and 11% year to year to 648 hours on 123,000 hours, plus $3 quarter over quarter and 140% year over year. Acquisition and market recovery. In Q3, overall EBITDA 30 million up from 80 million in Q2. High specs rigs, $80 to $17 revenue to EBITDA. Wireline services, completions and production, $61 and $11. Processing solutions, coil turbing, rentals, fishing, plug, abandonment, $37 to $11. Corporate, minus $9. Some seasonality in Q4, some noise around certain customers running out of budget, but equipment quickly spoken for. Why the market is staying disciplined from Wall Street Journal. Large asset managers are also pressuring oil giants to maintain capital discipline, i.e., spend less on production. Private US oil companies added 47 drilling rigs in the third quarter, while public firms added only one. Climate lobbyists want companies to return profits to shareholders or invest in green energy. Continental Resources founder Harold Hamm said this month he is taking his company private to have the freedom to explore. We have all felt the limits of being publicly held over the last few years. And in such a time as this, when the world desperately needs what we produce, I have never been more optimistic. Mr. Ham wrote to employees. High spec rigs. RNGR has 168 active rigs in a 1,000 to 1,200 rig market. The top six control 50 to 60% of the market, and this should continue to consolidate. Management indicated multiple discussions in high spec rigs and wireline and other services. Currently, price and structure, debt to equity, are obstacles, but are all moving in the right direction. Based on track records, we are giving management the benefit of the doubt that these potential acquisitions will create meaningful value. RNGR has 198 rigs of comparable quality, but will be very disciplined about putting the incremental 20% to work. Wireline. 45 active trucks versus 68 available. Significant revenue per margin upside and margin upside with increased utilization. Ancillary businesses. Fishing and rentals and plug and abandonment are all are growing nicely following the basic acquisition and have capacity well above current run rates. Coil tubing continues to grow and has a replacement value of 35 million versus an allocated purchase price of 2 million and EBITDA north of 5 million. Catalyst. Annualization of current run rate will demonstrate EBITDA and free cash flow of core plus acquired operations. Continued integration of acquired assets and increases in utilization of acquired excess cash assets in high spec rigs and wireline trucks. Utilization of soon-to-be debt-free balance sheet for further accretive M&A consolidation. Capital return policies in line with industry peers. Thank you very much for tuning in. See you next time.